Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at Beyond Meat.
If you find our talks useful, please consider subscribe, like, and comment underneath. And also be sure to check out the special 14-day trial link below in the description for StockOracle.
Right, because StockOracle is an AI-aided stock research platform.
Exactly. Just a quick reminder for everyone, it is not financial advice. It's not a trading signal service, and it doesn't provide real-time market data.
Yeah, and the AI insights and valuation estimates can be incomplete or just flat out wrong sometimes. So always make sure you verify the important facts yourself.
100%. Oh, and that link is an affiliate link, so the channel may earn a commission at no extra cost to you. So let's jump right into the wealth building context here. We are dissecting the life or death financial situation of Beyond Meat.
It is definitely a wild situation right now.
It really is. Our mission for today's talk is to look past all those doom and gloom headlines. We want to figure out if this company is just a dead end or, maybe one of the greatest hidden turnaround plays in the market right now.
Right, because the optics are extreme.
Oh, extreme is an understatement. To really understand the stakes, I want you listening to imagine you are standing on a sidewalk, just watching a massive corporate headquarters burn to the ground.
Okay, quite the visual.
Right. The roof is caving in, the alarms are blaring, the stock price has plummeted over 92% from its peak. I mean, everyone in their right mind is just sprinting out the emergency exits.
Naturally.
But then you notice something completely bizarre. A group of the top executives, the people who actually work inside the building, they're quietly walking back into the fire.
And they're carrying briefcases full of cash.
Exactly. They are buying up all the office furniture while the place burns.
That analogy perfectly captures the absolute absurdity of the current market contradiction we're seeing. You have a company in sheer mathematical terror, yet the people closest to the crisis are doubling down with their own money.
Right, which forces you to ask, what do they see through the smoke that regular retail investors are just completely missing?
Because the surface-level fundamentals are terrifying.
Oh, they're brutal. We are talking about stock trading for literal pennies right now. Around 56 cents. That's a 92.6% drop from a 52-week high of $7.69.
Yeah, and for most people, a chart that looks like that means bankruptcy is pretty much imminent.
Exactly. Yet over the last 90 days, corporate insiders have scooped up more than 2 million shares of their own company.
Which means we really need to look at how close this company actually came to the cliff edge. And the rather extreme financial engineering they just pulled off to delay hitting the ground.
Right, because that insider buying narrative is totally disconnected from reality until you understand their recent balance sheet maneuvers. So let's start with the bleeding.
Okay, let's look at the cash burn.
Over the last year, they burned through $134.2 million in cash.
Wow.
Yeah, and they were sitting on $493.7 million in debt against just $195.4 million in cash.
That is a massive hole.
And their free cash flow margin for the trailing 12 months was negative 50.6%. I mean, that is a brutal operational reality.
It really is. It basically means the core business model is currently fundamentally broken.
Right.
When your free cash flow margin is that negative, you are actively destroying capital just by keeping the lights on. It's completely unsustainable.
So why are insiders buying?
Well, to understand why they might be optimistic, you have to look at the trajectory of the revenue fall, not just the absolute numbers.
Okay, so I was looking at the quarterly numbers. In the fourth quarter of 2025, revenue was $61.6 million. That was down 20% year over year.
Right.
But then in the first quarter of 2026, revenue was $58.2 million, which is only a 15.3% year-over-year drop. I mean, it's still a drop, though. They are still losing sales.
In absolute terms, yes, absolutely. But markets don't trade on absolute failure, right? They trade on the rate of change.
What do you mean by that?
Turnaround investors live and die by deceleration. When revenue drops 20% one quarter, and then the next quarter it only drops 15%, that signals the bleeding is starting to slow down.
Wait, but why would it slow down? If the product isn't selling, shouldn't it just keep going to zero?
Not necessarily. Think about the life cycle of a really trendy product. During the peak hype years, you had millions of casual buyers.
Like the tourists.
Exactly, the tourists. People who bought plant-based meat just to try it. Or because, money was cheap and they didn't mind paying a massive premium for a novelty burger.
Right. But as inflation hit and wallets tightened up, Those casual tourists totally abandoned the brand.
leaving only the die-hard loyalists. The vegans, the strict vegetarians, the people with very specific dietary restrictions.
Okay.
So that 15.3% drop indicates they are finally washing out the last of those casual buyers. They are finding their true, sticky customer base. They're establishing a floor.
So the parachute is open, they are still falling, but terminal velocity is slowing down.
Yeah, exactly. Management actually predicted the Q1 2026 numbers almost perfectly, which proves they finally have a handle on what their baseline demand actually is.
But here's the problem. A slowing descent doesn't matter at all if you still smash into the ground. And they had a massive wall of debt coming due in 2027.
Oh, a massive wall.
If they didn't have the cash to pay it, that would just be an immediate bankruptcy, right?
Right. Which brings us to the lifeline. To avoid hitting that ground, management engineered a massive debt restructuring.
Okay, break this down for me.
They swapped $800 million in convertible notes that were due in 2027 for new notes due in 2030.
Okay, before we get into the actual swap, define a convertible note for me. Why is that specific type of debt important here?
Well, convertible note is essentially a loan that can be turned into equity. So shares in the company at a later date,
Okay.
investors buy them because if the company struggles, they still get their money back like a standard bond. But if the company explodes in value, they can convert that debt into stock and ride the upside.
But the problem for Beyond Meat is that if the stock price is in the gutter, like 50 cents, no investor is going to convert that debt to equity.
Exactly. They are going to demand their cash back in 2027.
And the company only has $195 million in cash. They literally couldn't pay an $800 million bill.
So they went to those debt holders and negotiated a delay. They pushed the maturity date back 3 years to 2030.
But there is a massive catch.
Huge catch.
The interest rate. They traded a 0% interest rate on the 2027 notes for a massive 7% interest rate on the 2030 notes.
Yeah, it's wild.
It's like hitting the snooze button on a ticking time bomb, but agreeing to a heavier penalty when you finally wake up. They bought 3 extra years, but the cost for that delay is massive.
It is a total desperation move. You don't voluntarily take on a 7% interest burden unless the alternative is immediate death.
Right.
By doing this, they de-risked the balance sheet in the short term and brought themselves the most precious commodity in the corporate turnaround world.
Yeah.
Time.
But this swap created a financial anomaly in their quarterly report that honestly made my head spin.
The phantom profit.
Yes.
Yes.
Because of this debt restructuring, they reported a massive $549 million non-cash gain.
Yep.
On paper, their net income shot up to $409.9 million. If you just looked at a surface-level stock screener, it would show this dying company suddenly has a trailing 12-month net margin of almost 92%.
Which is absurd.
Right. But in reality, their actual operations still posted an earnings per share loss of 29 cents. How does swapping debt magically create $500 million in profit?
This is a perfect example of why you can never just trust a top-line net income number during a corporate restructuring.
It's so misleading.
That $549 million is entirely a phantom profit. It comes down to how standard accounting rules treat distressed debt.
Walk me through the mechanics of that.
Okay, imagine you owe the bank $100,000. But you lose your job, your house is falling apart, and the bank realizes you're probably going to go bankrupt.
Sounds stressful.
Very. The bank might look at your situation and say, well, we'd rather get something than absolutely nothing. So they agree to tear up the $100,000 loan, and in exchange, you sign a new loan for only $40,000, but with a much higher interest rate.
Okay, I'm following so far.
Under standard accounting rules, you just saved $60,000. Your liabilities decreased. So on your personal balance sheet, you actually have to record that $60,000 difference as a gain or a profit.
Wait, so did someone hand you a check for 60 grand?
No, your bank account didn't increase by a single penny, but your accounting ledger shows a massive windfall.
That is exactly what happened here, just on an $800 million scale.
Exactly. The market knew the old debt was practically worthless, so when they swapped it for the new debt, the accounting rules forced them to recognize the difference in value as a one-time gain.
That is wild. It's a total accounting illusion that completely masks the operational bleeding.
It really does.
And this brings me to my biggest issue with this whole setup. Buying 3 years of time is completely useless if your core product is still losing money.
Right.
You can't just sell more of the same burgers to fix this because we already established the meat aisle is saturated and the casual buyers are gone. So 2030 is just a delayed funeral.
You're absolutely right to be cynical about that. And that exact panic is why management realized they have to abandon their reliance on the meat aisle entirely. The time they bought is specifically to execute a radical new playbook.
Right, let's talk about the catalysts. The geographic relocation within the grocery store.
The big pivot.
They are attempting a massive pivot into plant-based drinks. I have to admit, when I read this, it felt incredibly desperate. This feels like a struggling burger joint suddenly deciding the answer to their problems is selling milkshakes.
I totally get the skepticism. The beverage aisle is notoriously brutal.
Yeah.
You are fighting for premium refrigerated shelf space against entrenched giants of oat milk, almond milk, and soy.
It's packed.
But the logic here isn't just about throwing things at the wall. It's about utilizing their existing intellectual property and their one remaining competitive moat.
Which is their brand recognition. People know the BYND name.
They do.
But wait, how does making a fake sausage translate to making a good oat milk? When I think of a beef substitute, I'm not immediately thinking, oh, I want to drink a beverage made by that same company.
Think about the actual science of what they do, though. For the last decade, their R&D department has been solely focused on plant protein extraction.
Okay.
They spent billions figuring out how to take things like yellow peas and soy, extract the protein, and most importantly, mask the bitter, earthy flavors those plants naturally have.
Ah, I see. And the biggest problem with alternative milks right now is that to get high protein, they usually taste terrible.
Exactly. Most oat or almond milks have almost zero nutritional value compared to regular dairy milk. If they try to add plant protein to it, it usually gets chalky or just tastes like dirt.
Gross.
Management's bet is that their proprietary extraction and flavor masking technologies can create a superior nutritional profile in a drink without ruining the taste.
So the brand name gets the consumer to pick up the bottle once out of curiosity. But after that, the underlying food science has to keep them coming back. And there is a massive rumor floating around Wall Street regarding this pivot. Supposedly, they are exploring a partnership with a major, unnamed beverage company to help launch these drinks.
And if that rumor materializes, it fundamentally changes the survival calculus.
How so?
Well, getting a new drink into tens of thousands of grocery stores requires a massive distribution network and a ton of upfront capital. Two things this company definitely doesn't have right now.
I saw the phrase non-dilutive capital used in relation to this rumored partnership. What does that mean in this context?
So dilution is the enemy of the shareholder. If a company needs cash, they usually issue new shares of stock and sell them on the open market. But if you increase the total number of shares, every existing share becomes worth less.
Right, your slice of the pie gets smaller.
Exactly. That's dilutive capital. Non-dilutive capital means getting money without issuing new shares.
So in this scenario, a massive beverage giant might just hand them cash to co-develop these drinks or pay for the distribution themselves, meaning current shareholders don't get wiped out.
Exactly. It would solve their distribution bottleneck without destroying the stock price. But, as an investor, you can never bet the farm on an unconfirmed rumor. It's just a speculative catalyst.
Meanwhile, they're doing some serious internal housekeeping. I was digging into their corporate filings, and they disclosed a material weakness in internal controls.
Yeah, that's not great.
That sounds like a polite corporate way of saying their accounting department is a complete disaster.
It is a massive red flag for institutional investors. A material weakness doesn't necessarily mean intentional fraud or embezzlement, though.
What does it mean then?
Usually it's boring, but incredibly dangerous incompetence. It means their financial tracking systems are so flawed, like maybe the inventory software doesn't sync with the accounting ledgers, or there is a lack of independent auditor oversight.
Which means mistakes slip through.
Right. There's a reasonable possibility a multi-million-dollar typo could make it into their official earnings report without anyone even noticing.
Which completely shatters Wall Street's trust. I mean, if I can't trust the numbers on the spreadsheet, how can I trust the turnaround?
So they're aggressively addressing it. They brought in a new chief accounting officer and handed out specific inducement grants.
What are those?
They're basically stock-based signing bonuses. They're using them to stabilize the financial reporting function.
So they are essentially bribing an accounting expert to come in and untangle the mess.
It's a necessary cost. You cannot execute a highly scrutinized, multi-year turnaround if the market thinks your quarterly reports are guesswork.
Let's talk technicals and sentiment then. The table is set. We have a risky new beverage strategy, a massive debt delay with a high interest rate, and an accounting department in rehab. How is the broader market pricing this gamble?
Well, the overarching mood is overwhelmingly bearish. The stock is down nearly 31% year-to-date.
Ouch.
Expectations are scraping the absolute bottom of the barrel, but the technical setup on the trading floor is actually really fascinating.
Yeah, over a recent 5-day period, the stock actually returned 3.2%. It seems to be finding a hard floor of support right around that 50-cent mark.
Yeah.
But the volatility metrics are off the charts. The data shows a beta of 2.78.
Let's translate that beta for a second. A beta of 1.0 means a stock moves in perfect tandem with the broader market. A beta of 2.78 means this stock is highly, highly sensitive.
How sensitive are we talking?
Think of it like a tiny rowboat tied to the side of a massive cruise ship. If the broader market, the cruise ship, turns even slightly, the wake will violently toss the rowboat into the air.
Meaning if a negative macroeconomic event happens, this stock will crash exponentially harder.
Exactly.
But if a positive catalyst hits a good earnings report or that beverage partnership actually gets confirmed, it is primed for a violent upward repricing.
And there's plenty of liquidity to fuel that kind of violent move, too. The 10-day average volume is over 23 million shares a day.
So people are trading it.
Oh, yeah. This isn't a dead stock that nobody is watching. Traders are actively fighting over it. Which brings us to the consensus target price from analysts, which currently sits at 84 cents.
Okay, let's talk about that 84-cent target. When you are trading at roughly 56 cents, hitting 84 cents is a massive percentage gain.
Massive.
It implies that if management just executes the bare minimum of stabilization, the stock is heavily undervalued right now.
And this brings us all the way back to your opening hook about the burning building.
Right, the cluster buying.
Yeah.
We have 13 buy transactions versus 7 sell transactions over the last 90 days. That's netting over 2 million shares bought by executives.
Right.
But I have to challenge this. I read some sentiment reports that pointed out previous rumors of a CFO sell-off just months prior.
I saw those too.
So which is it? Are these executives buying because they genuinely believe in that 84-cent target? Or is this just cheap window dressing? Are they tossing a few $100,000 at a penny stock to trick retail investors into feeling confident?
It is the ultimate poker game, honestly. And window dressing happens all the time.
Right.
Sometimes the CEO will buy a small block of shares purely for the optical PR boost. But a cluster buy of this magnitude, specifically from multiple insiders across different departments simultaneously, usually suggests something deeper.
Like they know something we don't.
Or they are looking at the internal R&D data on these new plant-based drinks. They are seeing the daily sales data establishing that revenue floor. And they are betting their own personal wealth that the turnaround will actually work.
It aligns their financial interests directly with the shareholders.
Exactly. They are telling the market, we are strapping ourselves to the mast of this ship.
Let's transition to the risks and the bear case, though, because the risks here are still existential.
Definitely.
What are the specific upcoming catalysts over the next 3 to 6 months that will actually determine if the ship sails or sinks?
First and foremost is the Q2 2026 earnings report. The entire market will be watching one single metric. Did the revenue decline continue to slow down? If the decline reaccelerates, like if they drop 20% again, all the goodwill from Q1 just evaporates.
Poof. Gone.
Gone. They also need to provide concrete launch details and initial consumer feedback on these plant-based drinks.
And there is a massive macroeconomic wildcard sitting out there, too. Interest rates.
Oh, absolutely. Remember that new 2030 debt with the 7% interest rate?
Yeah, the heavy penalty.
If the Federal Reserve enacts interest rate cuts in the coming months, it could potentially lower the broader cost of capital, making their debt burden slightly less suffocating if they need to restructure again.
Plus, rate cuts generally ease the pressure on everyday consumer wallets.
Right.
When inflation cools and people have more disposable income, they are much more likely to spend money on premium, experimental grocery items like a high-tech plant-based drink, rather than trading down to the absolute cheapest generic brands.
It's kind of the perfect storm of macroeconomics and micro-execution, but we really have to balance this with the bear case. Let's hear it. If this drink pivot fails, the core meat business is simply not enough to sustain them.
Because of that negative 50.6% free cash flow margin.
Exactly. If the new products don't gain immediate traction, those operational losses will continue to chew through their remaining $195 million in cash.
And if they run out of cash before 2030, they will be forced into a highly dilutive capital raise.
Which means they would have to issue tens of millions of new shares at, say, 50 cents, completely wiping out whatever value is left for the current shareholders.
It's a textbook death spiral.
It is.
But let me pose a critical dilemma for you. When a stock has already crashed over 92% and is trading for literal cents, isn't the risk of failure already entirely priced in by the market? I mean, how much lower can expectations go when everyone already assumes you're going to zero?
Well, that is the defining philosophy of the turnaround investor. Priced in means the market has already mathematically factored the worst-case scenario into the current valuation.
Right.
At 50 cents a share, the market is essentially pricing this company for imminent liquidation. Therefore, any news that is simply less bad than bankruptcy is treated as massively positive news.
So the downside risk, while it's total, is mathematically limited to losing your 50-cent investment. But the upside, if they reclaim even a fraction of their former market share through the beverage aisle, is exponentially higher.
The asymmetry of high risk, high reward.
Which brings us to the final verdict of our evaluation today.
Let's sum it up.
When you aggregate the fundamental data, the technical floor, and the insider sentiment, our analysis provides a bullish score of exactly 4 out of 10.
And a 4 is a very intentional score.
It's not great.
It is not a green light for the average investor. This is strictly a speculative, high-risk turnaround play.
Right.
It is a speculative, multi-year strategy that requires immense patience, not a safe bet for a retirement portfolio.
Yeah. They executed a brilliant, albeit punishing maneuver to push their debt wall out to 2030. But survival is absolutely not guaranteed. It hinges almost entirely on convincing the world to drink their plant science.
Exactly.
For you listening, there are 2 massive takeaways from this analysis that apply to how you look at any struggling company. First, absolute growth isn't everything. Sometimes a slowing decline is the most powerful signal management can broadcast. It shows they're finding the bottom.
Right. And second, never take a net income number at face value.
Oh, yeah.
Because a distressed debt restructuring can create a $500 million phantom profit on a balance sheet, making a company look wildly profitable while they're still bleeding cash underneath.
So we go back to that burning building. The executives are inside, buying up the furniture, betting that the fire department in the form of plant-based drinks and macroeconomic rate cuts arrives just in time.
It's quite the gamble.
It is. But it leaves us with a much bigger, almost philosophical question for the entire industry. If a globally recognized pioneer, the brand that literally defined the modern fake meat movement, cannot make the math of plant-based burgers work without fleeing into the beverage aisle, what does that mean for the entire alternative protein movement?
Wow, yeah.
Is the meatless revolution actually failing, or is it just changing its recipe?
That is the multi-billion-dollar question that the entire grocery sector is waiting to see answered.
Something to chew on or drink while you check the price of your oat milk. Thanks for joining us for this analysis.
And don't forget to check out the StockOracle link in the description for your 14-day trial.
Yeah, and please subscribe, like, and comment below if you found this helpful. See you next time.